Hey everybody, Marty Mazzora here, Friday the 28th of July, 2023 with your weekly economic update. Folks, I'm just going to go through this and mostly just let the slides speak for themselves. I sent you a long commentary this morning on the equity market, talked a bit about macro developments, what we think about inflation and so forth going forward, and prospects for the markets. So in an effort to not be at all redundant, for this particular report, I'm just going to tell you how our index scored, add some commentary here and there, and run through the inputs that I decided to share with you today from our 47 and our index, and then finish with just a little bit on inflation. So we did get movement within the components, but when it all squared up, we stayed right at a negative 17, which says odds favor recession over the next, say, 6 to 12 months, over the prospects for the expansion to continue at this point. But again, as I mentioned, I think in yesterday's written blog post, the trend is improving, and it's not too difficult to understand where people are coming from when they talk about a soft landing for the economy, or this I guess no landing scenario, which I talked about in the previous video. Okay, so as for the inputs that I wanted to share with you, the general narrative, the GDP numbers yesterday and so forth, suggests that the economy's doing fine, inflation's coming down, and so on. So we want to get below the surface and look at the data in a little more depth, what it means, break it down, and so forth. Some of the stuff that's not showing up in the headlines, like the Red Book retail sales figures, which come out every week, back to a negative 40 basis points. And as you can see, that is well within the territory that we tend to see right during recessions or heading into recessions. So that clearly does not paint a positive picture about conditions right here. So personal consumption actually picked up, right? We're up on a month-on-month basis, 0.5%, which is an improvement over the last reading. However, personal income, while still rising at a nice clip, the rate of change has come down just a little bit on both a month-on-month and a year-over-year basis. Mortgage purchase applications are anything but impressive, as you can see here. Consumer confidence has been picking up notably. Levels aren't crazy high still, but man, the movement is nice, right? So that speaks to the improvements that people are seeing in the economy, strength in the jobs market, seeing inflation come off the boil a little bit. Notice the blue line that I included up here. So this is the Conference Board's survey. This is the University of Michigan survey. The blue line is the stock market. You can see there's huge correlation between these two surveys, but notice the correlation to stocks as well. So what I'm suggesting here is this recent uptick, I think to some extent, the degree to which, of course, we don't know, but to some extent, and this has been my observation over many years, has to do probably with improvement and bullishness around the current state of the equity market. Initial jobless claims actually came down notably from the previous week and notably below expectations. Now, I heard an economist yesterday make the point, and it was a good point, that typically this time of year you do see some seasonal fall off here, and it has to do with summertime and people who might otherwise be continuing to file for unemployment, and that came down a really nice chunk, and or new claims as well due to summer job availability. And we know there are a lot of job openings right now. So in the summertime, apparently we do tend to see a fall off in the jobless claims. So we don't want to make too much of it. It is encouraging, I will say, but there may be some seasonal factors in play that may get unwound as we move forward. So of course that remains to be seen. Durable goods orders, that was a positive. Certainly the headline number, not quite as much when we X out transportation. So that would be your core durable goods. And what doesn't show here on this particular graph is the previous months was actually revised a bit lower. So maybe not as good as it looks, but certainly net positive. Commercial and industrial loans, this is not net positive. As you can see, they continue to decline. So not a good sign, obviously, as it relates to corporate activity. You can see how these things tend to trend heading into recession. So very recessionary look here in C&I loans. The Chicago Fed National Activity Index, it's an index within our index, 85 data points. It scored negative in our index. We had it neutral prior to this month. Of the 85 inputs, 54 actually are scoring negative, 31 positive. As for our particular index, by the way, 23% of our 47 inputs are positive, 40% are negative, and 37% are neutral. The personal consumption expenditures deflator, so this is an inflation metric, and this is the one that supposedly the Fed focuses on. Year over year, core PCE rose at a 4.1%, so we're still double the Fed's target of 2%. And as I talked about in the video that I sent you earlier this morning, there are some very favorable base effects from a spike last June. The core does X out food and energy, so you don't have that energy fall off here. You do have that in the headline, which is up just 3% year over year. We anticipated this to be a somewhat soft number. Markets did seem to like the number, but going forward, the things that are working in favor of bringing inflation down for the second half of the year actually work against it, and will, on net, all things equal, will actually push inflation back up. So something definitely to keep our eye on. The employment cost index comes out quarterly, and we saw a nice decline there. That bolstered markets when that came out early this morning. Now, 4.5% is still big, so this takes into account wages and benefits and so forth. So historically, that's a very, very actually record, other than the recent record. So this is still an inflationary number, but it is going in the right direction for sure. And then last but not least in terms of my chart, the Bloomberg Commodity Index has taken quite the spike and moved above this downsloping wedge pattern, and that technically works the same as when we do this with the market. You see we had these bull flags going on, so that was a bullish look. As you can see, again, those who follow our technical analyses, this will look familiar. We had a bullish divergence on the MACD and ultimately a bullish divergence on the RSI as well. So that says good things about the state of the economy. I like it relative to what we expect out of commodities going forward. However, that's ultimately inflationary. So we've got to be careful, and I think the Fed does as well, before they actually let the pigeons loose and declare victory on inflation when we have some of these measures that are starting to spike back up. And then I want to quote, Peter Bookvar shared this morning, and he was quoting FreightWaves' commentary about the pending agreement that's going to keep the UPS workers from striking. I'll snip that and bring it over on the screen. So after the likely inflationary consequence of all government direct spending, okay, that was big in the GDP numbers, by the way. FreightWaves had an article yesterday that said UPS shippers, quote, should brace themselves for double-digit general rate increases in 2024 as the transport and logistics behemoth looks to recoup the astronomical cost increases from its tentative 5-year contract with the Teamsters Union. Bookvar says inflation is far from being dead, and a lot of inflation volatility is to be expected in the coming years. I could not agree more. In fact, as I continue to make the point, our view is that inflation is going to trend higher than the Fed's 2% target after we get through whatever's left in the cycle. As it's still our view that a recession is in the offing, inflation will be notably higher on a trend and on an average basis than that 2% Fed target for years and years, in fact, probably for decades to come. So we don't think the 2% target will be the target, if there will be one at all, after we get through whatever's left in the current cycle. So folks, on that, I will wish you a great weekend and be back next week. Take care. Thanks again for watching and listening. Bye-bye.